I think we're going to get started here. Welcome to the New York City Accelerator's Financial Case Studies webinar. I'm Andrew Chintz. I'm the financing specialist at the New York City Accelerator. And today we're going to be presenting some actual case studies of some of the available financing options for energy efficiency and building decarbonization projects. And we're excited to present this topic and this panel of lenders. Last I heard, we have nearly 600 registrants, and so this is clearly a topic of interest. And I just want to thank all of our panelists and all of the attendees for participating with us. Today's webinar is actually a new installment of a series of financing webinars that we've held in the past. We did a two-part webinar series a few years ago called Financing 101, just to present the different types of financing options that are available to building owners in New York City to help them comply with Local Law 97. And last year, we followed that up with a session on case studies. We presented three different case studies from three lenders and three different financial products. And so today is really an extension of that, a part two, if you will, of that last year's event. So we're going to show you three additional examples of the project financings. And as many of you are aware, the EPA has recently awarded $27 billion under the GGRF, under the IRA, and that funding is now filtering into and down to the various lenders, and we'll be seeing new loan products funded by that money, and we expect that that'll be available at least by first quarter 2025, if not before. And so I expect that we'll hopefully do another financing webinar to include those programs as well. So you get started here and just go through our agenda. I'm going to just kick us off with a quick overview of the New York City Accelerator, for those of you that aren't familiar with us, and just talk a little bit about very high level the different financing options that we have, just to kind of put in context the lender presentations that you'll hear. And then you will hear from three different lenders. We will hear from NYC and PACE Equity about PACE financing, and then Verdant Capital and Inclusive Prosperity Capital as sort of the non-PACE lenders, if you will. You can look at it that way. And then we will have, we've kept a lot of time reserved at the end so that in the past we've had quite a few questions, and we will get to that soon. You can put your questions in the Q&A as they come up, but we'll respond at the end. Laura Perano is my colleague on the finance team at the Accelerator, and she'll be managing the flow of questions to the different panelists and try to make sure we get through all of them. So just to meet our presenters, Ethan Elser is Executive Vice President at PACE Equity, and he's going to be talking about a PACE loan that closed last year in New York City. And before he gets started, though, we wanted to take this opportunity. We've invited Kyle Madden-Peister from NYC. He's a senior legal associate at NYC, and NYC is the PACE administrator for New York City. And Kyle's going to give a little bit of overview on PACE, but really focus on two very significant changes to the rules for PACE in New York City, which we think will expand the eligibility of projects to qualify for PACE financing. And we're very excited about it. We think it's really going to ramp up the PACE market in New York City. And next we'll hear from Josh Patton, the Vice President at Verdant Capital. He's going to talk about an equipment loan that is coupled with a Con Edison program that provides interest rate subsidy. And then we'll hear from John D'Agostino, who's Managing Director of clean energy transactions at Inclusive Prosperity Capital. And he'll be talking about their Catalyst Loan product. So what is the Accelerator? Again, for those of you who don't know, it's a New York City program. It's sponsored by the Mayor's Office of Climate and Environmental Justice, and it is a free service to building owners and other market participants to help basically all types of free technical assistance to help buildings assess their properties and determine what kind of projects they can do to comply with local law 97. We can lead you to incentives. We oversee a map of over 70 incentive programs. We keep that up to date, and we can refer you to the relevant incentive programs. We have a service provider network that we vet service providers through and also can refer them to you. And we can help you with your feasibility of solar on your rooftop. And so really just a lot of services that are available and again, all free. How does it work? The buildings that are eligible are anything over 5,000 square feet, privately owned. If it is smaller, or if it's a 1 to 4 family building, we do have partners that we can refer you to. How does it work? Just give us a call and you will get an account manager assigned who the account managers are divided up into different building types, and they'll be your point person and give you this customized service. And again, all of this is free. So what we also do is provide financing assistance, and that's where I get involved with Laura, and we help the buildings once they've determined the project that they want to do, the scope and the cost, and the incentives, and they want to finance the remaining cost of the building. We can help them identify the various financing options that are available and basically assist them in navigating through that process. We would help them connect to the different lenders when they are relevant for those lender programs, and basically stay involved and engage with them, help them assess their options, and really stay involved as long or as little as they want. That what we also have is a capital provider network where we bring in different financing options. We have 15 different options now. I just want to mention also that if anybody, any lenders are out there, please contact us if you're interested, if you have financing products that might be useful for building decarbonization or energy efficiency. We'd love to have you join our network. So this is just a bit of a visual to basically the same thing that I've just mentioned, but just sort of goes through the different process, the different levels of stages of process for us helping you with your financing. So just wanted to give you a quick overview of the different options for financing. You know, if it's a new building or you're at the end of a capital cycle and you're ready to refinance your mortgage, that's always a good place to look to finance this work. There are green mortgages which can lend you additional money at lower rates when they look at underwriting the savings that you can create from the work. But most buildings are not at that stage, and so most of our products are mid-cycle financing products. We have specialty finance companies, sort of the local green banks and CDFIs, nonprofit lenders. Today you'll hear from Inclusive Prosperity Capital from John, and that's what they are. We have New York City Accelerator PACE financing. You'll be hearing about that as well today. And we have equipment lenders. And again, you'll be hearing from Verdant Capital about that today as well. The non-debt financing is the as-a-service product. It's a different type of product that we won't be talking about today, but it is another one of our options. And the 15 different lenders that we have in our network are all fit into these different categories. So I think I'm going to pass it off to Kyle so he can present on PACE in New York City.
All right, thank you, Andrew. I'm going to share my screen and hopefully get this into presentation mode. So yeah, thanks, Andrew. I'm Kyle Madden-Peister, Senior Legal Associate at the New York City Energy Efficiency Corporation, NYC. As Andrew mentioned, we are the administrator of the New York City PACE program on behalf of the city. So since I know we have a big audience today, I'm gonna kind of go over the main points of how PACE works, the New York City program, and then get into some of those changes that Andrew mentioned. So starting off, just very basic points. PACE, Property Assessed Clean Energy. It's a tax-based assessment, and it's used for financing long-term financing for energy efficiency and renewable energy projects. PACE loans are made by private lenders. They're qualified lenders. That's part of what NYC does as administrator. The PACE loans are repaid on properties tax bill that's sent to the Department of Finance. The PACE charges a separate line item on the tax bill, just like a property tax. The PACE loan is non-accelerating. That's important, different from a mortgage. If a payment is missed, the only amount that is due is the outstanding amount and any interest or whatnot, but the whole loan can never be accelerated. And when appropriate, PACE is useful for passing along the charges through leases, and the PACE loan can be transferred upon sale of the property. So those are just some high-level points on how PACE works. Here's some on the New York City program. Again, it is only for energy efficiency and renewable energy projects, as well as any related work that's necessary to accomplish those measures. New York City is an open market, so any lender that's interested can apply to become a PACE lender. As I mentioned, there is a review and approval process. Currently, we have 15 qualified lenders in the New York City program. You can see them on the PACE website and their contact information. They range from specialty PACE lenders to JP Morgan Chase, and we expect that number to increase. So New York City is a commercial PACE program. In this context, that means all properties except for 1 and 2 family residential. So if you're 3 units or plus, you do qualify as a commercial property in the New York City PACE program. I will note that condos are a little tricky. We hope there's a pathway for some, but generally speaking, since condos are individually owned units, they likely won't qualify in the New York City program. The loan terms are set by the lender and the borrower. There are certain required features. New York State law requires that the interest rate be a fixed number. That number, though, is determined, privately. It's not set by the program. The loan term cannot be longer than the average useful weighted life of all the measures. So if you have a solar project that has a 20-year lifespan, the loan itself cannot be longer than 20 years. It could be shorter. But besides that, there aren't really many requirements. So again, the kind of details are worked out privately. As mentioned, the repayments are made on the property tax bill. Importantly, mortgage holder consent is required. So if there's a senior lender on the property, they will have to sign off on PACE. That is a point of focus in the PACE market and something that we're working on, as well as Andrew and Accelerator. And I also note that in New York, energy audit or feasibility study is required for all projects. So with that, I will move on quickly about NYC's role as administrator and then on to the updates. We are the administrator. We work with the city, all the various city agencies that help run the PACE program. We interface with the lenders and other stakeholders. I would note that the program's mostly set up so that NYC as administrator deals mostly with the PACE lenders rather than borrowers. So the accelerator is more kind of the borrower facing, and NYC as administrator is more lender facing, but we are certainly here to answer questions and help move projects along. And that is one of our main responsibilities, is that the last point down there is we review and approve project submissions that are submitted by the lenders to the program. We also review and approve the qualification process for lenders, and going up into the middle, we are responsible for remitting the funds that are paid from the building to Department of Finance, from Department of Finance to the PACE lender. And that is actually what I'm going to do here. I'm going to do this pretty quick, but this is just kind of visual of how PACE works and the flow of funds starting from top left and working clockwise. The funds, the loan is made by the lender to the property owner. To the right, the property owner repays the loan on their property tax bill. Down to the bottom right, Department of Finance collects the repayment of the loan by the borrower on the property tax bill and sends it to NYC as administrator. And bottom left, NYC as administrator remits those funds to the PACE lender. So this is schematic. I think can be helpful. Again, all these slides will be available after we finish. So going on to the program status. So yeah, the updates that Andrew mentioned, one of which is that the program is now open for both retrofit projects of existing buildings as well as new construction projects. And that's a recent change for new construction. It's been kind of a long time coming. So new construction projects can utilize PACE financing in New York City so long as they are all electric. As defined in program documents, essentially means they can't use any fossil fuels on site. There are some exceptions. The one thing I'll note down there at the bottom is that the PACE amount can't be more than 30% of the total project cost for new construction. Again, it's only for new construction. And project cost is all the hard and soft costs for completing the new construction project, minus any amount spent on land acquisition. So there's been a lot of interest on new construction side from the PACE market. We expect it to hopefully, really help support it and help build some all electric, buildings. And I wouldn't, as is up there in the second bullet point, the PACE program and these changes that I'm talking about now are really geared to support New York City's policy of promoting electrification in new construction, and also now onto retrofit projects. This is my last slide. I know it's a lot of text, but so on the retrofit side, just starting off, New York State has what's called a savings to investment ratio, or previously had a savings to investment ratio for all retrofit projects for PACE. And, very big, basically, is that savings are, the project savings and investments, the project cost, and the ratios, the cost divided by the savings, and it was supposed to equal 1.0 or greater. That was intended to ensure there are benefits to the project. Sometimes it could be limiting for retrofit projects to meet that savings investment ratio 1.0 or greater. So some recent changes have kind of opened up the door. And the most recent one that's there in the third bullet point is that for retrofit projects that result in a building becoming fully electrified, the entire project is exempt from meeting the savings investment ratio. So if you have a $10 million retrofit project, the building does no longer uses fossil fuels, all $10 million qualifies for PACE financing. Of course, you would have to find a PACE lender and still do that, but all 10 million would qualify. So that's a big change. also, existing component was that even for retrofit projects that do not result in full electrification, certain electrification measures are pre-qualified and also do not need to meet the savings investment ratio. And those measures are electric HVAC, so heat pump systems, electric domestic hot water systems, and electric energy recovery systems. So again, $5 million in heat pumps, all $5 million qualify for PACE financing. And lastly, the last change that we hope will help with the retrofit side is that for building enclosure measures, so for example, windows or insulation that kind of traditionally had trouble meeting that savings investment ratio 1.0 because they simply don't have the payback to the high cost, but they're very important, especially in a sort of holistic retrofit project. Those building enclosure measures can now be calculated with a different methodology. It's called the incremental cost approach. I'm not going to explain it, try to explain it here. But the takeaway is that, it's sort of, let's say, more forgiving in terms of calculating that savings investment ratio 1.0 or greater, and therefore will allow more projects that have these building enclosure, these windows, these insulation, they will be able to qualify because using this alternative methodology, they will therefore meet the requirement that previously they would fall short of. So with that, I think I am over time, and that's a very quick overview. I'm happy to take questions at the end and follow up, but we're very excited with these changes. And I'm gonna pass over to Ethan at Pace Equities for him to talk about it from the lender side. So thank you, and I'm gonna stop sharing.
Well, thanks, Kyle. And thought that was a good preview and introduction. I see a lot of great questions coming in. I'll try and maybe touch on a couple of those as I can during my presentation. And again, we've got a pretty good Q&A session after our presentation. So if not, we'll touch on them then. I'm going to go ahead and share my screen. So as was introduced by Andrew, my name is Ethan Elser. I'm EVP and a principal here at Pace Equity. Pace Equity is a direct balance sheet C-PACE lender. Our company is about 10 years old, but our principals were involved in helping to start PACE programs all over the country and driving adoption. We do just kind of big picture, two different things. As Kyle mentioned, and maybe some of you were taking away, there are a lot of different steps to completing a PACE project. So in addition to being a direct balance sheet lender, we can, I'd say, kind of, if helpful and wanted, provide value by making an approach that encompasses the energy engineering, working with mortgage lenders to have them provide the requisite approvals, aka consent. I know there were some questions about that. Can touch on that more maybe in the Q&A section. With PACE, which is of course a really great tool, there are nuances. The New York City requirements are a little bit different than the New York State, which are different than other states around the country. So our team specializes. We have on-staff energy engineers, transaction specialists who understand all these different rules and requirements and can really help kind of guide you through the whole process. So what I thought I'd do, I'm going to talk a little bit more one about New York City specific case study, but hopefully also just where PACE funding is being used and is accretive. And Kyle mentioned that really any kind of commercial property that does include co-ops. I know there was a question about that. So co-ops are eligible for PACE funding. But any kind of office, hospitality, multifamily, senior housing, some specialty asset classes, those are all eligible to be used. And I would think kind of broadly about if you're doing a commercial construction project, and that might be something like, again, you're retrofitting your building for local law 97 compliance. That might be you're building a new building. That might be you're adding solar. That might be you've got a manufacturing facility and you're putting in some new equipment. All of those count and are eligible for potentially for PACE financing. So as Kyle mentioned, any improvement you're doing that has, you know, an energy spend impact, a water spend impact, a renewable, you know, impact is eligible. That might be 100% of your project cost. That might be a little bit of your project cost. So all of those are, you know, really great opportunities. And I would say where a lot of people are using PACE financing is to fill a gap. That might be because, you know, access to capital is a little bit challenging. You know, you might be, you know, kind of have maximized what your lender, your mortgage lender, is able or willing to lend you. That might be, you know, you don't have a loan on your property and you're not looking to borrow, you know, traditionally, or there might be some strings associated with that that you're not looking for. So again, I think, you know, generally PACE financing is used, you know, kind of over and above those scenarios. One area that, you know, we can be used as well, we can fund projects, you know, even if you say recently improved your building or recently built your building, that is also eligible for PACE financing. And what a lot of properties right now are using capital to maybe, you know, do a cost overrun funding, or, you know, maybe extend the maturity of their current loan, you know, in an environment where access to capital, again, is a little bit difficult. So those are just some of the common scenarios, you know, that we're seeing people using us for. So turning now to a specific project, this is a project that PACE Equity funded in Brooklyn. And this is a skilled nursing facility. It's actually a nonprofit. So that, you know, that might be a question. Again, that might apply to maybe a co-op, you know, as well. So, you know, properties that are for-profit or nonprofit owned are eligible for financing. And in this case, you know, there were, I'd say, a lot of different, you know, reasons why this project was working with us. They had actually started installing a CHP, or combined heat and power, to just make their energy use. They've got really high energy bills, partly because the building is a little bit old, but partly because of the use. So their goal was to reduce their energy costs. Two, they had some, I'd say, kind of needed improvements that they needed to do just to kind of keep, you know, up to current codes. And then, of course, knowing that the local law 97 requirements are coming, they wanted to just try and get ahead of that. So ultimately, what they ended up doing, in addition to the combined heat and power, was upgrading all of their lighting, rooftop units, and then some other, you know, HVAC improvements. And we funded $5.2 million for that, with some, I'd say, pretty strong results. You know, one, of course, this allowed them to meet, you know, the current local law 97, not maybe all of them that are coming, but, you know, kind of the initial round. They came out a net positive from an annual, when you look at the benefits, from the energy savings, a lot of the kind of, with the older equipment, they had a lot of, you know, maintenance costs. So we were able to really mitigate all of that. And one thing I think that's, you know, also worth mentioning, Kyle alluded to this, but just to, you know, make sure it's clear, is that PACE funding can cover 100% of all the qualified costs. So again, in this case, all that this property was doing was, you know, PACE eligible. And so we can cover 100% of those costs, not the incremental costs, not a portion of them. So I think that's, you know, also worth understanding is, you know, there might be a question of, you know, why is PACE a better fit? Well, again, there's no upfront costs. You're getting all the savings. You're locking your interest costs. There's no, you know, personal guarantees. And again, you're getting all of that funding to cover qualified costs. What I thought I'd do too is, so that was a New York City, you know, specific project. I just thought I'd also talk about some other projects that we funded that, you know, would be good just to get the audience, you know, thinking about, you know, different use cases we can cover. So this, I included this was a project we funded in Cincinnati, but I included it because it was actually an office to multifamily conversion. And this is a great example of the developer of this project had started, they had run into some increased costs of construction. We were able to come in mid-construction and fund those costs rather than, you know, going back to their investors. You know, their bank was, you know, not really wanting to extend them an additional loan. So this is a great, use for, a PACE lender to come in and cover those costs, and without making kind of any changes to their design. I think that's another thing is, a lot of projects, a lot of buildings, again, whether it's a renovation, a redevelopment, a ground up new construction, they're already qualifying for, kind of your local PACE standards, even if you're not necessarily thinking about that going in. And that's why we're able to step in, mid-construction, even if people weren't contemplating PACE financing on the front end. And then just piggybacking, off of what Kyle shared, which is that, we can now fund low carbon, ground up buildings in the New York City PACE program. This was a project that we funded last year that, had, again, going back to some of the questions of the audience, maximized what, they were able to, borrow from a traditional bank lender. We always encourage our clients to do that, but they were still looking for additional capital. The amount of equity and investment that was needed to fund this project, the numbers didn't pencil. And again, that's where, we were fortunate to get introduced to them, and we were able to come in and help solve that gap. That way, this is in the Crenshaw part of Los Angeles, definitely a big need for housing there. So again, there was really a gap in that capital stack that was preventing us from moving forward. We're able to come in and close that gap and see this project, ultimately constructed. So it wasn't like replacing, bank debt. It was just, we were creative to solve that gap to, see this great project be developed. So with that, again, appreciate just the time to speak and hear about, different ways that people are using PACE financing right now. Look forward to your questions thereafter.
All right. Thanks. Appreciate that, Ethan. My name's Josh Patton. I'm Vice President of Verdant Commercial Capital, and I'm here today to tell you about the financing solutions that are available through our programs, specifically in New York City, where I know most of you or all of you are from today here. I'd like to thank the New York City Accelerator for having us on today, and looking forward to showing you what we have to offer. I'm going to share my screen here. Give me a second to put it into presentation mode. All right. Great. So I want to introduce you to myself and my team. As I mentioned, Josh Patton from Verdant Commercial Capital. There's two other individuals that are on our energy efficiency, renewable, and e-mobility team, which are the types of projects that we finance. Jonathan Wickersham and also Chris Herman. I'll have this slide at the end as well that you can see and have a way to contact us. Let me tell you a little bit about what Verdant does, who we are, and what we do. Verdant is an equipment financing company. We have a product that is similar to traditional financing, yet a little bit different than what most building owners and businesses might be used to in terms of financing. Our terms are available anywhere from 2 years to 7 years. Our typical projects are anywhere from $25,000 up to $50 million, with most of those projects in the $100,000 to $5 million range. This is debt financing, but it's a little bit different than traditional debt financing because we do not require any sort of subordination from any existing lender that might be involved with the business or a mortgage on the building. So it's much easier. It's a smooth, simple financing process. We try to make it as easy as possible for either contractors to offer our financing to their customers, or if customers have projects directly want to come to us, more than happy to help them with those. We're a private equity-backed company. We're backed by 2 large insurance companies and a family office out of the Cincinnati, Ohio area. Again, we try to make this financing as simple as possible. For our contractor partners, we do provide proposal tools that allow them to quickly provide financing payments to customers depending on the type of program that you're running through. We service C&I customers, multifamily customers, nonprofit customers, small business, you name it, any sort of business that's out there, we have a solution for. We've funded $2.5 billion in funding since Verdant's inception in 2017. So we have a pretty big balance sheet and have a pretty aggressive market out here that we're looking to move forward with. Our go-to-market strategy is a little bit different than most lenders out there. Obviously, we have a big appetite for this green energy market. We work through various different utility companies, partner with them, as well as green banks or other state agency programs, put programs together for them, and oftentimes have contracts where the utility companies will actually buy down our interest rates to as low as 0%. So aggressive rates, simple financing, it's a really good mixture and makes it easy to move forward with financing. Today, we're going to talk about the Con Edison and National Grid programs that would be relevant to New York City and the surrounding boroughs. First one we'll talk about is Con Edison. We have a contract with Con Edison to offer low-cost financing as low as 0%. This is a program that has been running now for a few years, and it's available for C&I customers. It's available for multifamily as well as small, medium business customers. So if you have a project that is being run through either of those three programs and is incentivized through those programs, then we can offer financing that has an interest rate buy down portion that lowers that interest rate for the customer. This is not on bill. Verdant bills the customers directly for this. Oftentimes we set customers up on ACH payments, make it easy to pay that way. It does not affect the amount of the incentive. This bought down financing is an extra bonus on top of the incentive. So it's really important to know that it's available and utilize it when possible. Available for custom and prescriptive projects, and financing can be combined with other non-incentivized measures. A little bit more details on the Con Edison program. We have target interest rates that we buy the rates down to depending on the term of the loan. Terms can be anywhere, again, between 24 months and 84 months. It's 0% for 24, 1.99% for 36. 48 months gets bought down to as low as 3.99, 60 months, 4.99, 72 months, 5.59, and 84 months, the lowest rate is bought down to 5.99%. We don't require any sort of down payment up front for our financing. It's very simple, very easy, clean process. It's set payments for a set term, and that's the way we have our financing set up. As a general rule, if Con Edison incentive is greater than 30.5% of the amount being financed, then these target rates that are listed on the screen will be available. If for some reason the incentive is not as strong, maybe the energy savings isn't as high as a project is, or it needs a longer term or something along those lines. In those instances, what we'll do is we'll utilize the maximum amount of subsidy available and still be able to offer an interest rate buy down for the project. It'll just be below market rates, not all the way down to the target rate. As a note behind the scenes, Con Edison provides Verdant with a subsidy amount of up to 30% of the amount financed. I'm sorry, a Verdant amount, 30% of the incentive amount, and that's financed by our rate buy down. There's also another program for downstate C&I gas for National Grid, another low cost interest financing program. Within this market, any C&I gas customers where there's a project that's being incentivized through their programs can have interest rates bought down to as low as 0% for 24 and 36 months, and as low as 1.99% for 48 and 60 months. Again, this is a program that may not get the lowest possible rates, and National Grid's programs are dependent on the actual energy saved. So there's an incentive application that gets filled out. The contractor estimates the number of therms saved for a project, and the subsidy that National Grid provides the Verdant is an additional 50 cents per therm saved to buy down that interest rate. So depending on how many therms are saved for the project, projects that save a lot of energy are able to get bought down to a very low level. Projects that don't have as many therms will still maximize the interest rate buy down as much as we can to provide financing for that project. Go through a couple of case studies here. I've got 3 of them here, projects that we financed in the recently here. The first one is a condo building in Lower Manhattan. This was run through the Con Edison Multifamily Energy Efficiency Program. The project, the building was upgrading HVAC controls and some optimization software. The total project cost was about $228,000. We financed $124,000, which is the amount after the $104,000 incentive. The term ended up being 48 months, and because there was enough incentive included through the Con Edison program, we were able to buy that down to the lowest target rate, which is that 3.99% for 48 months after the subsidy was applied. The building had great savings. They were actually cash flow positive from day one every month, $1,532 based on the energy savings and the monthly payments. So it was a really good project for them, really happy. Quick ROI for them. But obviously the main focus was to be compliant with local law 97 fines. In the first year, $17,503 a year avoided for the first couple of years, and then starting into 2030, they'll have an avoidance of $8,783 a year. So great project for this condo association. We've financed a ton of condo associations in New York City, a lot of multifamily buildings, both affordable and market rate as well. Commercial real estate, offices, office building, retail, hospitality, nonprofits, businesses, manufacturing, you name it. Those are all types of projects that we consider and approve within our programs. Next case study is a project that was run through the National Grid C&I gas program. This Brooklyn Conservative Jewish Community Center was replacing their boiler plant. The project amount that was financed was $600,000, and we were able to buy that interest rate down to 4.99%. It didn't qualify for the full buy down for the project, just based on the energy savings that were included, but we were able still to buy this interest rate down to 4.99%, which was lower than the market rate that's available and still allowed the deal to close. There was a $60,000 incentive for this project. The therms saved were $12,479, and we were able to provide a 60-month rate at 4.99%. We also structured this a little bit differently. The first 6 months were structured at a lower payment, and then started stepping up those payments after that amount. Those were all structured and set up front. The customer is well aware of those situations and asked for it to be a little bit more affordable for the first 6 months. So we accommodated them for that. So nice project, good program, able to get a project done through the National Grid C&I gas program with some interest rate buy downs for this community center. Case study 3 is a 47-story condominium building in Manhattan's financial district. This was run through Con Edison's multifamily energy efficiency program. Trane was the contractor, and they were replacing or installing water source heat pumps. Project cost that we financed was $3.3 million. The incentive was $257,000. Good saving project with 436,000 kilowatts saved, 736,000 kilowatt hours savings as well, and MMBTU savings were 2,511. It was set up through the condominium building. There was an assessment to their to their tenants that was agreed upon to pay for these. And we were able to set it up on a 36-month term so that as the heat pumps were installed, payments could be made by the tenants rather than paying for them upfront. It was a really good solution for them. Tenants were happy, condo association was happy about it, and they were able to close a fairly large transaction and with the bought down interest rate financing that we had. It wasn't super aggressive on the rate just because the energy savings weren't as high for the dollar cost of the project. But we still were able to subsidize the rate and lowered it by about 100 basis points, which was enough for the condo association to say yes to the project. So a couple different styles of financing available for a couple different types of businesses, but these are the kinds of things that we do. I'll kind of go over some questions that might be coming up. Our financing does not require cash flow positivity. If the ROI on a project is 10 years, but you want to finance it for 5 or 2 or whatever it is, it's not a requirement on our side. So it makes it easy. Any sort of project that is being financed through as an energy project will qualify. Whether or not it qualifies for interest rate buy downs will depend on if the project is incentivized through those utility companies that I mentioned earlier, through one of their qualifying programs. But if there's a solar project that needs financing, we still finance those projects. That would just be outside of the interest rate buy down, and it'd be more on a market rate solution for those customers. But we finance a lot of solar, a lot of EV charging projects. Those are all within our purview. Go through quickly the financing process, and I think I'll be out of time here. So it's really quick and easy, like I mentioned. If you're a contractor out there, reach out to us. We'll get you set up with some payment quoting tools that you can start offering this financing to your customers, depending on whether it's a Con Edison qualified program or a National Grid program or something outside of that. We have tools that make it easy for you to show what the payments work out to be for your customers, make it easy for them to say yes. Once a customer is interested, an online application is completed. If it's what we call small ticket, which is anything under $250,000, oftentimes it's just a credit application that we receive. If it's a real estate entity that there's really just not a lot of business credit behind it, then we will ask for some financial statements to be able to take a look and see if we can set up an approval. Our approval ratio is 80-85% of the projects that we see get approved. So we're very aggressive. We're not like a typical bank that might look at 25-30% of our projects improve. So we are aggressive in that sense. If it's above $250,000, then we require a full financial package, which would be 3 years of financial statements. If they're not audited, then we look for the tax returns to back those up, a debt schedule on the business, and then also interim financial statements. With that package submitted, it's typically a 48-hour turnaround time on the larger projects over 250,000, and we can quickly approve that and move forward to documents. From the contractor's side of things, it's really nice because we do provide some of those funds up front. You don't necessarily have to wait for the project to be completed before you receive some of those funds to be able to go out and purchase the equipment from your supplier, pay installers, do all the things you need to do behind the scenes. We do provide pre-funding. So talk to us about that and we'll get you set up. As a customer, it's nice because you don't necessarily have to put up a deposit for this financing. You can have zero down and we can move forward with financing in that sense. So that's the process. I'll skip to the last slide again that has our contact information. Would love to hear from you. If you're a contractor, let us know. Reach out. We can set up a training with you and your sales team and provide you with the tools to be able to offer financing to your customers. If you have a project that's within one of those territories that you want to talk about, we can talk about that very quickly and walk you through that process. If you're a customer and have a project that's upcoming, let us know. Typically, we get involved once and a contractor has been picked. You have a proposal from them with an amount that needs to be financed. And typically, we get involved once a incentive application has been submitted, if there is an incentivized project. With that information, we can quickly show you what kind of rate we can offer and move forward to the underwriting process. But that's pretty much it for me. Would love to hear from you. If you have a project or if you're a customer that would like to move forward with a project, reach out to us. I think next up is John. I'll stop sharing and flip it over to John.
Great, thanks, Josh. Let me go ahead, see if I can pull this open. All right, that looks right. Okay, so so everyone, thank you for the introduction. I'm cognizant of time, so I intend to be brief, talking a little bit about Inclusive Prosperity Capital and our financing offerings. And so at a high level, Inclusive Prosperity Capital, we are a nonprofit green bank. We actually spun out of the Connecticut Green Bank about 6 years ago and brought a number of financing products with us and solutions and approaches to the market, if you will, to operate nationally, which we do. And so clearly the conversation today is germane to New York City, where we've been engaged with the Accelerator for a good period of time, and have seen a lot of folks that have come to us. Our offerings are a little bit unique from the prior ones, and I can kind of talk that through as we go. So at a high level, I'm going to be focused very specifically on our Catalyst term loan, which is in the upper left corner of this slide, but just kind of showing all the different ways that IPC plays in the market. We offer pre-development lines of credit for energy improvements. We offer construction to perm financing. Most folks, term loan offerings go to 7, maybe 10 years. Our term loan starts at 7 years and goes out as long as 20 years, not to exceed the underlying useful life of the measures that are being installed. So a little bit of a differentiator, and part of the cause for that is recognizing that there's a gap in the market for long-term financing for longer term equipment, whether it's heat pumps, boilers, furnaces, and the like. So really that's the area where IPC has chosen to focus. We offer a single family residential infrastructure. We ourselves are not a lender, but we provide support and credit facilities for single family LMI originators in the market. And then over on the right, we also have a solar ownership platform. We are a lender to solar projects, especially those that extend nationally or at least outside traditional banking jurisdictions and utility jurisdictions. So lots of different approaches to the market. Focus today on our Catalyst term loan product. Don't need to kind of go down the weeds here, but you see in the second cell, Catalyst term loan is designed to support energy improvement projects on low to moderate income, but underserved gaps in the market from a financing perspective. So this includes cooperatives, condominiums, and as well as nonprofit counterparties. We don't lend to small and medium commercial businesses. We focus specifically on multifamily and nonprofit counterparties for this product. And typically it's for mid-cycle properties, so you don't need to be at a financing event. We can work during a financing event, but we've designed the Catalyst term loan to be either subordinate or, as it's traditionally defined, unsecured, with just UCC1s on the installed equipment to play nice, if you will, with existing mortgage providers. So offering in New York City, as I mentioned earlier, 7 to 20 years. It's primarily, we are an energy financier, so our interest is specifically in energy, but it can also fund health and safety and resilience improvements. Typically, how we think about this is no more than 25% of the loan can go towards these non-energy specific or like ancillary related improvements, because at that threshold, it's kind of becomes less of an energy loan and more of a generic loan. And we have, as an intermediary, attested to our funders that we're going to focus on the energy improvements. That's the primary focus and the primary interest, and the health and safety that comes along with it. It can be included, but we don't want it to be too large of a portion of the total loan advance. I mentioned eligible building types before, so affordable housing, co-ops, condos, housing authorities, subsidized housing, nonprofit government buildings. From a security perspective, we take a flexible approach to the market. At a minimum, we expect and need UCC1s on the major equipment that's installed. If underwriting dictates. We can either come at the market with merely a subordination agreement, or a subordinate mortgage, or reserve accounts, or guarantees. Really, the goal is to try to provide financing in really hard to underwrite spaces where traditional mortgage financing or PACE financing doesn't work. This product was actually designed in Connecticut, where Connecticut was the CPACE financier, the CPACE administrator, and was designed as an alternative to CPACE, recognizing that CPACE didn't work in all instances. So really, it's that approach to the market, understanding that it is challenging to get lender consent at times, and so being able to play in a subordinate position helps catalyze the market in these hard to underwrite spaces. So unfortunately, we don't have projects that have closed in New York. We have a lot of projects that we're working on that we were hoping to finish by now, but haven't quite crossed that finish line. So in the interest of protecting folks' identities, this is an example of a loan that we did complete in Detroit, Michigan. Counterparty here was a nonprofit environmental organization focused on green education and outreach in the Detroit metropolitan area, called EcoWorks. And EcoWorks was in the process of looking for financing for basically an energy conversion. They had two different wings of a building that they owned, and they were trying to integrate an antiquated heating system. And their solution here was to do kind of a variable refrigerant flow heat pump system. And so we were approached for this opportunity. We have an existing partnership with Michigan Saves, who's the nonprofit green bank in the state of Michigan. And we worked with them to devise a solution. The need for EcoWorks as a small nonprofit was they didn't have a lot of cash on hand on their balance sheet. They didn't have a lot of cash flow. And so we were trying to figure out a way to make this project pencil for them. And so we offered a longer term loan, 15 years, availing ourselves of Michigan Saves credit enhancement through the form of a loan loss reserve to support this improvement. So the loan amount here was for 100% of the project cost at $559,000. And I don't have the annual savings, might be on the next slide, but the $175,000 of projected lifetime energy cost savings from this HVAC integration project. At a high level, just kind of looking at the Catalyst term loan terms and underwriting criteria, we have a pretty simple underwriting process where we're basically just looking at current ratio, debt service coverage ratio, and then reserve amounts. And you can see here, EcoWorks was checking all of those boxes. So it again, like having Michigan Saves in the market as credit enhancement helped facilitate, but this is the kind of project that we really focus on, is traditionally underserved, hard to underwrite, hard to pencil, finding a flexible approach with longer terms to help make cash flows pencil. At the time, the interest rate was advanced, that 15-year term was 6.49%, 3% closing fee that was capitalized into the loan amount. So there's the annual projected savings of $11,716. And the security here was just a UCC1 on the associated project equipment, along with the credit enhancement by Michigan Saves. I covered most of this. I should also mention, it's mentioned here, so this is actually the original equipment that was replaced. In addition to the HVAC electrification, the heat pumps that were installed, there was also asbestos remediation that we were able to fund as part of this project. I think that was about 15 to 20% of the turnkey cost. So this was really catalytic for EcoWorks in the market. They were on a journey to kind of complete their greening. I think they had already had a solar PV system at the time, and so they were trying to kind of lock in. This was the last step and really the largest cost to them to come across that threshold and being able to kind of claim their green achievements. And so just to date, it's been a really successful project. The monitoring is going really well. We remain in close contact with Michigan Saves about future opportunities, and we're hoping to bring this approach to the market for the projects that we're working closely with the accelerator on and looking to close in the next couple months. Just a few items on construction risk. We worked closely with Michigan Saves as well as the borrower to kind of evaluate the construction timeline. There was a need for prefabrication by the contractor of the Mitsubishi units, and so there's a large upfront cost there with construction risk absorbed. So it was helpful to have Michigan Saves in the market for that, but it's something we always want to keep our eye on when we're advancing very early in the process. Loan repayment, in addition to the energy savings, we have the ability to underwrite operational savings and insurance savings of the project. So that just help to really enhance the cash flow and the underwriting process for longer estimated useful life mechanicals that were installed. And then we have ongoing energy monitoring, just to make sure that, the energy system itself is performing as designed, and to anticipate any kind of like financial duress issues as the project proceeds over time. I can wrap it there. I mean, what I can mention right now is IPC is, we're in the market. We've been in touch with the accelerator. We have funding availability, looking primarily, as I mentioned, for terms in north of 7 years, typically in the 10 to 12-year range. Interest rates are currently in the high sixes, 6.75 to 6.99. We're committed to kind of holding those rates for those terms. And looking for opportunities to deploy, especially smaller projects south of $500,000 is ideal. It just gives us flexibility on deployment timing. So if anyone's interested, and I'm happy to share a link in the wake of this presentation to our application materials. I can go ahead and pause there. I know we're tight on time to hand it back.
Thank you so much to all of our panelists and to all the participants and all of their questions. So we've had a number of questions related to PACE, and I'd like to start with that if I may. There have been some questions about lender consent, and is PACE available to those with an underlying mortgage? And can you talk a little bit about the position of a PACE loan? Thank you.
I can just quickly say from a program level, and then maybe you can give some.
Sure.
So yeah, as I mentioned, if there is a mortgage on the property, then in the New York City program, lender consent is required. There's a program form for it. It can sometimes be a sticking point, but I'll let Ethan talk about on the ground experience. PACE is senior to a mortgage or to any existing debt, but only to the amount that is due at the time or past due. So like it's non-accelerating, the whole PACE loan is not senior. It's only any amount that's due at that point, like a property tax. You kind of think of PACE the same way. I mean, that's the purpose of it, that it's treated and it's thought of akin to property tax or in the same class, although in the stack, it's technically right below it because the city always gets paid first, but PACE is right below it and then would become any other debt below that. And then Ethan, I don't know if you want to talk maybe from your side.
And just to add on to that too, that an important qualifier too is that any kind of enforcement is through some kind of tax enforcement. And so when Kyle kind of talks about the senior status, that is only triggered if let's say the mortgage holder were to let a tax sale go through, and that is an extraordinarily unlikely event. At any time up until then, any arrearage can be caught up, whether that's by the borrower, the lender, some kind of other loan. So there's been extraordinarily few actual kind of tax sales where that kind of priority has occurred in the PACE industry, probably less than a half a dozen, or something like that. So I think kind of getting to that point, 20 things have to go wrong. There's a lot of runway for those to be figured out and worked through before that could kind of literally occur. So on the ground, I would say there's Kyle was touching on some kind of the structural elements of PACE financing, and I would say what we do is very misunderstood by lenders, right? People kind of hear the tax status, and there's just a natural kind of that sounds a little scary. Not sure I'd be willing to get comfortable with that. So I think for us, one, it's important for the audience to know that you have to do education with your lender about those structural components. And that's something, your PACE lender the accelerator itself, can do as well. And I would, of anything, I would strongly encourage that, because frankly, until you kind of get on the phone with a PACE expert to talk to a lender really, they need to make an educated decision. Until they have that knowledge, they're not going to be in a good position to. So that's one. I'd kind of qualify that also by saying that for PACE equity, we were funding hundreds of millions of dollars of transactions a year. In those, the majority of those have a lender who's never before consented, approved. So again, we're doing that education, and it's working just by nature of our business, and the whole industry is growing. And then third, I'd say I think some of the pushback too, there's again that lack of education about the structure. But I think also it's making sure it's being properly utilized. It's got to make sense. It's got to create value. So, in the Brooklyn United Methodist Church home project we funded, we're improving the value of the building. We're reducing operating costs. We're fixing old equipment. That's a very clear and demonstrable value proposition. So again, if it makes sense, I think you got to have kind of the story down about how is this adding value to the property. And in many cases, it's actually making it a better building, improving the security interest for the lender.
Okay, thank you so much, Ethan. So we're gonna switch over to some questions for Josh at Verdant Capital. And some of those include are contractor and consulting costs covered by your financing? And do you have a list of the type of equipment eligible for this financing, for the Con Ed subsidized financing?
Yeah, sure, absolutely. So we're not as concerned about soft costs as most lenders are. So consulting and any sort of fees that are added on top of that into the amount being financed is allowed. It's very, very open program, not a whole lot of restrictions for those. So that's not an issue on that side of thing. In terms of the types of equipment that we finance, if it's an incentivized measure through a utility company, then we will finance it. That's the easiest way I can explain it. I could talk for about 15 minutes about every single type of measure that's out there, but it's really easier just to say that if it's incentivized through a utility company, then we can finance it. On top of that, we'll also include solar. If it's not incentivized, that's fine as well. We finance TPO roofs oftentimes also, either in conjunction with a solar project or outside of that in certain instances. And then a lot of EV charging and the EV charging infrastructure required to put the EV chargers into the ground. All those fall within types of projects that we will finance.
Thank you, Josh. We do have another PACE question. Are payments made on a PACE loan deductible similar to real estate taxes?
Yeah, I would say if you ask 10 accountants, you'll get 4 different answers. So generally speaking, I mean, yes, but I would qualify that you and your accountant have to be kind of comfortable with that. I will say that if you do that versus depreciating the improvements and writing off the interest, you're usually not coming out much different from a tax perspective. Now, some people are balance sheet constrained, so that's an important consideration. So I would say, again, we don't love to take a position only because your accountant's ultimately the one who has to be comfortable with that. But there's absolutely people who do, and absolutely an argument that you can.
Thank you. And the next question is for John with Inclusive Prosperity Capital. A number of participants have asked about funding for HPD, middle income co-ops, nonprofits, universities, specifically colleges. What type of and condos? So can you comment on your qualifications for your loans for these types of buildings?
We are able to lend to any of those counterparties. I think a university is a more interesting counterparty, and it for me, it always begs the question of like, why aren't funds available given university resources at scale, right? But like, so long as they are a nonprofit, there's no prohibition for us, so long as we understand kind of the gap that we're filling. But yeah, that entire universe is fine.
And for those loans, you're including conversion from oil or gas to electrification. And a specific question was about windows. Would they have to meet a certain energy efficiency qualification and so on? Can you comment on those kinds of projects?
So we're not in the business of dictating folks' scope of work, right? And so fundamentally, if it is an energy improvement in however qualified, that is sufficient for us. We rely upon utility designation of energy savings, or we can also rely upon a professionally licensed engineer or a certified energy manager's attestation of energy savings. So long as we can lean on some sort of a technical expert of whatever savings are. I mean, some of the question begs as how much savings relative to the cost, and we have underwriting criteria, but we also look at a global DSCR, so we have flexibility in terms of improvements that may have a marginal savings but a high cost. It's still available. We don't use SIR as a metric for underwriting. It's part of the reason we come to market with longer term financing in order to make harder to underwrite lower marginal energy savings projects pencil over longer terms.
Thank you so much. And I'm going to open this up to the panelists. Do you offer financing for non-energy related costs? For example, if you need a roof replacement to install a solar array, what kinds of non-energy costs do you include?
I can go first, and I kind of mentioned this previously, is we typically look at about a 75-25 split of, we think of the 25% as ancillary energy related scopes of work. So if you're doing a boiler replacement and there's a roof replacement, that's harder to justify. If you're doing a solar project and a roof replacement, we consider that ancillary and related. So we typically look at about 25% as our threshold, but yes.
I'll speak. Verdant Commercial Capital will consider those projects. It's specifically roofs. We finance just roof projects, and usually there's some sort of energy efficiency that we can bring into the project based on what kind of roof is being installed. And of course, if it's a roof that is also with a solar, that we would finance the whole package together. If it's something that's really outside of that, Verdant also finances non-energy projects. We have a number of different industries that we finance into: titled vehicles, machine tools, other types of equipment outside of energy that we also finance as well.
And I would just say, from the PACE program side, ancillary costs are also eligible in the New York City PACE program. So again, as long as sort of same theme, it has to be necessary and related to the project. So, for a solar project, roof replacement would certainly be related and would be a qualifying cost. Also, we do have what we call health and safety category of ancillary costs. So, for example, you're doing a project and you have to do asbestos remediation because of that project. Those costs would also be eligible under the program.
Hey, thank you so much. We have another question for Josh in terms of the subsidies. One was a question about the commercial and industrial financing with National Grid. Is that the only building type that receives that subsidy? And then also, have you included a buy down rate for the clean heat program with NYSERDA?
Yeah, great questions. Currently, the contract with National Grid for downstate New York, we have a contract with upstate New York that has C&I gas, electric, the New York clean heat, small business. All of those are upstate, as well as in Massachusetts, we have electrification program and the C&I programs out in Massachusetts. Currently, the downstate program is just the C&I gas. We are in talks to add the multifamily program specifically, but that's not finalized yet. We've just started having those conversations. What was the second part of the question?
I think that was about the buy down rates and also National Grid. What other, are there any building types other than commercial and industrial that that buy down rate is available?
Sure.
National Grid.
So the buy down rate for downstate New York and National Grid is specific to the CNI gas program. So the incentive would have to be run through that CNI gas program in order to receive the buy down. We could still do the financing for any other project, for any other building type, whether or not there's incentive or not. We're very flexible in offering those types of financing. However, with the interest rate buy down, it has to be through that CNI gas downstate New York National Grid program. On the Con Edison side, we have the CNI, we have SMB, and we have the multifamily program. And there's, we have a contract for the clean heat program. It's just not set up yet for the Con Edison territory.
Oh, okay. Thank you so much, Josh. We have
I'm
some more.
I'm going to jump
Go
in
ahead.
here because we are at time, and I know we get lots of questions. We got through some of them, and I think we'll have to sign off. I want to really thank the panelists for a great job, great content, really helpful. And just to leave you all with, if you take away anything here, please come to the Accelerator for any of these services that I've mentioned, including financing assistance, and we can help figure out whether your project meets the criteria for these loans that you're hearing about, as well as others, and help you facilitate the process. So thanks all for attending. And if there are questions that we haven't gotten to, again, if you can contact the Accelerator, we can answer them. Thank you all.
Thanks, Andrew.